Over the past week, global foreign exchange markets have experienced severe whiplash following the escalation of kinetic conflict in the Middle East. The immediate catalyst hit today, April 13th, as the U.S. Navy reportedly initiated blockades of Iranian ports. This strategic maneuvering has injected a massive geopolitical risk premium back into the market, specifically targeting nations that import their energy. This has solidified a dominant macroeconomic trend: buy energy exporters and sell energy importers. The collapse of direct U.S.-Iran peace talks in Islamabad has fractured the emerging market landscape, decoupling currencies that previously moved in lockstep. To manage this shift, we must analyze the resulting Asian energy squeeze, the aggressive capital rotation into Latin America, and the specific digital treasury playbook corporate finance leaders are adopting. For institutional investors, actively bifurcating emerging market exposure has become a necessary strategy to mitigate risk. The diplomatic failure in Pakistan has created a structural divide in these currencies that traditional fiat hedging is no longer equipped to bridge. From late February through April 7th, the initial blockade of the Strait of Hormuz systematically drained capital from energy-importing nations across Asia and Africa. This chart shows the resulting depreciation. The South African rand fell 5.4% against the dollar. During that same period, the Thai baht suffered a 4.6% decline. The South Korean won also declined, losing 4.3% of its value against the greenback. These economies share a structural reliance on Middle Eastern oil imports, which creates a direct currency drag when shipping lanes are threatened. In South Africa, the rand faced additional pressure from gold price weakness, hitting one of the nation's primary trade commodities. For these importers, geographic distance from the conflict provides no safety. Their currencies remain tethered to the volatility of the Hormuz choke point. This chart highlights a specific, notable exception to the regional sell-off: the Chinese yuan, which remained entirely flat at 0.0%. China remains a massive oil importer, yet its currency absorbed the Hormuz shock without budging. The resilience stems from China's infrastructure. Its electricity grid relies on 60% coal-fired power and 15% hydropower, rather than imported oil. This domestic power mix serves as a structural shield against Middle Eastern energy volatility. Combined with accelerating March inflation indicators, this energy insulation allowed the yuan to maintain stability while its neighbors depreciated. Internal grid composition has become a more accurate predictor of currency resilience than gross trade balances. The market briefly pivoted on April 8th following the announcement of a U.S.-Israel-Iran ceasefire agreement. Sudden short covering sent the rand, baht, and yuan aggressively rebounding, as shown by this sharp reversal in the trend lines. That optimism proved short-lived when direct talks in Islamabad collapsed over the weekend of April 11th. With no future talk dates announced, the lack of diplomatic progress has paralyzed market participants. As naval blockades take effect today, stalled trade at the ports has completely dampened investor sentiment. The brief buying pressure that supported Asian currencies during the ceasefire talks has officially evaporated. Headline-driven optimism often masks a deeper structural breakdown in diplomatic leverage. Institutional capital is now rotating away from Asian FX and toward Latin American markets. The Brazilian real has emerged as the primary beneficiary of this allocation shift. Brazil provides a dual-layer defense: geographic insulation from the Middle East and high real interest rates. High real yields continue to attract global carry trade capital, looking for both safety and return. We are also seeing inflows into the Hungarian forint, driven by specific domestic political shifts. These resource-rich economies stand in direct contrast to the energy-starved profile of many Asian importers. The divide between energy-poor importers and high-yielding exporters has effectively split the emerging market asset class in two. For multinational corporations, managing this fractured landscape through traditional fiat hedging has become prohibitively expensive. This diagram shows the friction. The conventional fiat path is slowed by widening bid-ask spreads and significant correspondent banking delays. To solve this, Treasury teams are shifting cross-border emerging market liquidity to digital asset rails. Using USD-backed stablecoins allows for instantaneous B2B settlements. This shift bypasses the localized currency volatility that typically spikes during geopolitical flare-ups. It allows Treasury reserves to remain anchored to the US dollar while executing regional trade. The capability for 24/7 instantaneous settlement is essential when markets must react to sudden weekend developments like the Islamabad collapse. Digital rails provide the necessary defense against the structural breakdown of traditional emerging market banking. Despite the ceasefire collapse, corporate leaders should avoid aggressively shorting Asian emerging market currencies right now. Both sides in the conflict are seeking negotiating leverage rather than total economic destruction. However, any sudden resumption of diplomatic back-channel talks could easily trigger violent and completely unpredictable short squeezes across the global market. CFOs should instead maintain elevated cash buffers to manage regional supply chain costs. Flexible option structures are preferable to high-stakes directional spot trades. The Q2 playbook is clear. Rotate toward Latin America, adopt stablecoin digital rails, and hedge using options. The goal is risk mitigation and liquidity, not speculation on kinetic outcomes. In a fractured market, the most successful finance teams prioritize structural insulation over the risks of market timing.